All right, well, in tonight's class, we are going to go through the basics of my approach and really build a number of concepts and techniques so that you can analyze any stock quickly, any market quickly, and really start to succeed in the market. My approach is pretty simple, and I think you'll find that as we go through, it's going to be quite easy to understand, and I hope you'll get a lot of value out of it. So, what's on the itinerary for this presentation? Well, as I said, I'm going to teach you some simple techniques to analyze any stock quickly. By the end of this presentation, you'll have the basics understood, where ultimately with practice, you'll be able to analyze any stock in 10 seconds or less. And with practice, you can do it quicker than that. I'm going to help you establish the skills you need to understand the other classes this week. Of course, this is the first of 4 classes. And tomorrow we're going to talk about investing. On Wednesday or Thursday, we're going to talk about day and swing trading. And then on Saturday, talk about the tools that I've created. In order to understand those presentations, you really have to understand what we do tonight. So tonight's going to be real important. And I will take questions at the end so that we can make sure everyone's on the same page. You know, we want to be able to avoid stock market crashes. We want to be able to pick stocks. I'm going to show you how I'm able to pick stocks that make dramatic gains, whether it's dramatic gains in a single day for a day trade or dramatic gains over months for a position trade. And of course, in the middle, we have swing trades, and we'll talk a little bit about all of those. We also want to be able to avoid big losses. You know, no investor, no trader is right all of the time. So we need to have a methodology for when to take the loss, and I will teach you that as well. And then I'll sort of give you some next steps towards beating the stock market, a few of the different resources that I offer to help you do well. And then at the end of the presentation, I will take some of your stock questions and we'll analyze your stocks for you. I won't be able to do everyone's because we have literally hundreds of people in here tonight, but we'll try to do a few and just emphasize the skills that we have gathered through this presentation. All right, so let's get right into it. So we're going to start with stock analysis basics. I'm going to teach you these 8 things, and they are inflection points, optimism, pessimism, support, resistance, price volatility, abnormal activity, and trends. If you can understand these 8 things, you can analyze any stock, any crypto coin, any commodity, any currency. You can analyze it quickly. Even real estate prices can be understood using these 8 things. But we're going to have to do it piece by piece. So we're going to take a concept and then build on it. So I'm going to start with inflection points, and then we're going to see how those determine the next 5 or 6 and trends at the end. And we can apply this for long-term investing. If you are someone who just wants to manage your portfolio over, whole periods of weeks, years, months, doesn't matter, even hours. I have some trades where I might only hold the stock for 5 minutes. It all uses the same methodology that I'm going to teach you tonight. So whether you're a day trader, a swing trader, a position trader, a long-term investor, these skills are applied in the same way. It doesn't matter. We're going to apply them to stock charts. I'm not really a typical technical analyst. I don't use anything but my own indicators and my own concepts. And so it's not going to be that technical. It's pretty straightforward. But we need to begin with the basics. So let's dive right in and look at inflection points. Now, before I do that, just as kind of a funny picture, this is from a New York Times article back in 1996. What is that, 30 years ago almost, 29 years ago. And I bring it up because this was when I started creating my methodology, which is really based on indicators and algorithms and that sort of thing. Now, on this picture right here, this guy right here, his name's Sean, and he was the first programmer that I ever hired. And so what I did with him is I took the things that I was doing in my trading way back then, and I said, let's try to build some indicators, some mechanical, computer-driven processes to identify opportunities. And so I would give him the math of what I wanted to do, and he would program it. Back then it was being programmed on a Sun workstation, which I don't even know if they exist anymore, but that's what we did way back then. So this is sort of the genesis of what we're going to learn tonight. And to be quite frank, it hasn't changed a lot. The market is still driven by fear and greed. And if you can sort of understand how human psychology works and how information spreads in the stock market, you get a sense that you can predict stocks using some simple techniques. So let's dive right in and look at a chart here of a stock that I picked back in late November. And what I'm going to do is begin by describing those things that were on that list. And the first thing on that list was inflection points. And this is a sort of the building blocks of chart patterns. So if you can understand inflection points, then you can start connecting the dots and start to read when a stock has good potential and when it should be ignored. So what is an inflection point? An inflection point occurs anywhere price stops going up and starts going down. So that's an inflection point top, or stops going down and starts going up. That's an inflection point low. And you can see that I can identify lots of little peaks and valleys on this chart. So I'm just looking for anywhere there's a little bottom or a top, and those are the peaks and valleys. Those are the inflection points. I haven't drawn every one on there, but that's most of them, I guess. So your first step in analyzing a stock is to see the inflection points, to see the little peaks and valleys. And what we're going to do is connect the dots to start to define different concepts. Now, the next two concepts on our list were optimism and pessimism. So if you can connect 2 points and it's rising from left to right, so I've connected this point right here and this little inflection point right there, and you can see that it's going up from left to right. So that means there is optimism there. And in fact, in general, this chart has optimism because the bottoms are generally rising on the chart. Now, there are very short-term periods of pessimism, and you can imagine if optimism is rising bottoms and pessimism is falling tops. And so if you have falling tops on the chart, then you have pessimism. Now, sometimes we have both. You know, here I could say we have optimism, but we also have pessimism. So that is a neutral chart pattern. All right, so far we've covered inflection points, and we've covered optimism and pessimism. And I think most people will agree that that's pretty simple so far. Now, the next concept is support and resistance. Support and resistance is defined by these inflection point lows or inflection point highs. They are the ceilings and floors. So if we have an inflection point high right here, and we draw a horizontal line at the inflection point high, we have defined a ceiling price, which we chartists call resistance. Now, it's going to be very important why we do that in a moment. You'll learn all about this. Right now, we're just covering the building blocks, and then I'm going to start to show you how to predict when stock prices are going to move significantly. So that's resistance. Support is the opposite. So anywhere you have some inflection point lows, try to draw a line that best fits as many as possible, and that is support. Now you can see that this little point here went a little below, and this one's not quite there. This is an art, not a science. You don't have to be exact, just as this little point went above a little bit. We want to draw the line that best fits as many points as possible. And so we have defined an area of support in green and an area of resistance in red. So there's support in green and resistance in red. Now I could do more. You know, there's a line of resistance there. There's a little line of resistance there. There's one there. Anywhere you have a price peak, you can define resistance. And anywhere you have a price floor, you can define support. Now, some of you may be experienced in charting analysis and may think that this is a little bit boring at this point, but trust me, stick with it. We will get more sophisticated as we go through the presentation. All right, so far we've covered inflection points, optimism, pessimism, support, and resistance. A couple more. The next thing we're going to talk about is price volatility. This is where it gets a little more complex because price volatility is based on how much price is changing over time. So let's compare this period with this period. So we're going to call this period number 1 and this number 2. In period number 2, there's not a lot of price volatility. Price is very narrow. You can see that we were trading around $3.25 there. And for the course of, I don't know, 5 or 10 days, the stock was in a narrow trading range without a lot of volatility. So we can say at that point, price volatility was low. So we'll give that an L for low volatility. Whereas over here at point number 1, this circle, we've got price changing significantly. So there we can say that price volatility is high. So if I was to capture all the periods of low volatility, all I would have to do is look for areas where price was trading sideways. So there's low volatility, there's low volatility, there's a little bit there. And if I was going to capture the periods when price volatility is high, I might say, well, there's high volatility, and then even in here, quite high volatility. Now you might say, well, that's kind of obvious, but why do I need to know this? Trust me, in just a few minutes, it'll all make sense. Here's some more high volatility right here. Now, the last thing that we're going to talk about before we get into trend is this concept of abnormal activity. And this is my secret sauce. This is the basis for pretty much every trade, every trading strategy that I do is based on abnormal activity. Now, why is abnormal activity important? Well, abnormal activity occurs when there is some new information that comes into the market that gets investors either excited or fearful. So if you have a stock that's trading at, say, $10 a share and it doesn't have a lot of volatility, and then one day it jumps to $12 a share, it makes a 20% move. And it does so with 3 times as much volume as normal. That is an indication that investors have learned something new about the company that justifies those investors paying a higher price. So let's say that stock's trading at $10 and it's a biotech company, and they get some results back on some clinical trials that they're doing on a new drug. Well, when they announce that trial data, those results from the clinical trials, you might see that stock make a big jump all of a sudden. And the reason why is the company's ability to make a profit has suddenly improved because they have some new fundamental change that drives that price action. So we have to remember that stock prices, even when we're looking at charts, this is all based on the fundamentals of the company. And it's actually the perceived fundamentals of the company, because humans, through our emotions, perceive what the company is worth based on information. All right, so why does that matter? Well, this may be a news flash, but the stock market isn't fair. Some people get better information than others. There are investors who either have a lot of insight and knowledge about a particular industry. So, an institutional investor might know a lot more about that company's clinical trials, the development of their new drug. They might know a lot more than you or I would. And so they have an advantage. Of course, there's also the people that work at the company. They have better access to information. There are the people that follow the stock very, very closely that would know more than the general public. So all of these people have an advantage. And when they learn about something new, they're usually the first ones to jump in and buy the stock aggressively. And that's what creates the abnormal behavior that people like me follow, and soon you, because I'm teaching you how to do this. So if you've got a stock that trades at $10 a share and it's kind of boring, and then all of a sudden one day it trades 3 times the normal volume and makes a big jump in price, it's probably because there has been some new information that's come to the market and it has motivated some buyers to buy the stock aggressively, moving that stock up sharply. And that is the clue that we look for when we're looking for stocks that may be worth buying. It's the abnormal activity. So looking at our chart here again, if I highlight some abnormal activity. You can see here, let's draw this in blue. Here the volume increased, and here the price started to behave abnormally. And then here you had an increase in volume, and here the price started to behave abnormally. Here we've got some abnormal price gain with a little bit of abnormal volume, although it's not great. Now notice that when this stock started to trend up, and it's done really well, it started with abnormal activity. Abnormal price, abnormal volume almost always start a strong market-beating trend. So if you want to find the stocks that can beat the market, the first thing you have to look for is abnormal activity. Now, comes with a caveat. Almost all stocks that make market-beating returns start their gains with abnormal activity, but not all abnormal activity leads to market-beating gains. So I'll say that one more time because it's very important. Almost every stock that does well will start that period of doing well with abnormal activity, and you can see that here. Here's the abnormal activity, the abnormal volume, and the stock went up from there. However, not all abnormal activity leads to market-beating trends necessarily. So there are certain times when we see abnormal activity where we're actually going to ignore it. Now, as I get into the presentation, I am going to show you specifically when we think about buying, but I don't want to get there just yet because I want to teach you just a little more to make sure we understand that list of key concepts. So let's look at another example. This stock is listed on the Canadian market. Here we have a period of low volatility. The stock was going sideways. We didn't really have optimism or pessimism because it was just all the tops seemed to be more or less at the same level. All of the bottoms seem to be at more or less the same level. It starts to build optimism in here when we start to get rising bottoms. So we have optimism sort of starting in here when we're starting to build these rising bottoms. There is resistance at this price level right here. You can see that every time it hit that level, about 75 cents, the stock would get stuck and it would go down. It would try again, get stuck and go down. Try again, and this time it finally broke through that ceiling price. And notice that the volume was higher than it had been. So we had a breakthrough resistance from low volatility with abnormal activity. And that started the stock moving into a strong upward trend where it went from 80 cents to over $1.90. So more than 100% gain in just 2 months or so, 2.5 months. Okay, let's look at another example. Now this time I'm going to look at a day trade. This is a stock that we traded yesterday in my active live service, which you'll learn more about later in the presentation. So in this service, we pick day trades and we have algorithms running and all kinds of computer analysis running during the trading day. Notice that this is the 24th of March, and yesterday it started trading way more volume than it did on the 21st of March. So there we have abnormal volume. A little different in this case because it's a very short-term chart. This is a 2-day, 2-minute chart. So very short-term. This is for day traders. It has optimism and it has periods of low volatility. There's one right there. And it had one right here as well. Now this will all become more important as we go through the presentation. Now, before I teach you where to pick stocks, let's talk about how we can avoid stock market crashes using what I've taught you so far. Because markets do not crash lower overnight. The fastest crash I have ever seen was the COVID crash. That was pretty quick. That crash happened very quickly, but even then it gave us warnings, and I'm going to show you that warning in just a minute. So as I say here, impending weakness leaves clues. We don't have to necessarily anticipate market weakness. We have to react to the first sign of market weakness. In order to do that, we have to understand the concept of trend lines and reversal patterns. We always want to trade with the trend. So the market is way easier if you're trading with the trend. The trend of the North American markets over the last, 3-4 weeks has been down. But over the last many years, numerous years actually, well, since 2022. 2022 was a down year, but since 2022, the market has been in an upward trend. And in the last, like I said, few weeks, we've had a bit of weakness. So how do we know when the market is going to reverse? Well, this is all you need to understand right here. A break of an upward trend line from a falling top, or a break of a downward trend line from a rising bottom. That are trend reversals. So let me draw this for you. So I'm just going to make my screen here. Whoops. Okay, so this is how it works. Trends. Sorry, I'm going to try that one more time. Okay, so a trend line goes like this. It consists of a move up and a pullback, a move up and a pullback, a move up and a pullback. And we can draw a line across the bottoms to define the upward trend line. All right, and as long as the stock or a market is in an upward trend, we stick with it. However, at a certain point, that trend line will be broken. That is our first warning sign that the market may go into a crash, or if it's an individual stock, that the stock may reverse. But typically what happens is it builds a falling top, which is what? A falling top is pessimism. So we go from optimism, because we have rising bottoms, so the market is in control of the buyers, and we switch to falling tops, which is pessimism. And when you get a breakdown of an upward trend line from a falling top, that is a signal to sell the stock or the market. So now let's apply that to a chart of the S&P 500. So here, and you can't see it because I only got 3 years on here, but this was the COVID crash back here. And you'll have to trust me, but there was a trend line there that was broken. Okay, that was the very quick, took about 5 weeks. The market moved down, 30% in 5 weeks. But then we had a nice long upward trend. My drawing tool keeps blipping out here. Okay, so there was a very long upward trend, and it was broken right here. Now, why was that broken? Why did the trend reverse in early 2022? Because interest rates started to rise. And that broke the upward trend line. Then the market built a falling top and broke down from a falling top. So we had sell signal number 1 there and sell signal number 2 there. And over the next, the rest of the year, the market was in a downward trend. So this was your first clue to get out of the market, and this was your second clue to get out of the market. Up until that point, we had a tremendous bull market all the way through here. It was fantastic. Now, when was it time to buy the market again? Well, we're going to apply that same methodology. So I'm going to draw a downward trend line. I'm going to start my downward trend line at the top, and I'm going to let it fall across the inflection points. Okay, so we started this class talking about inflection points. There they are, right? And all I've done is connected the dots to draw a red trend line. And I can see that there is a rising bottom here. And I broke the downward trend line right there from a rising bottom. So the market switched from pessimism to optimism because I had rising bottoms. And then I broke the downward trend line right there. That was the time to buy the market again. So we had a sell signal here and a buy signal right there. And what happened? Well, you can see what happened. It went into a nice long upward trend. Now the first trend line, if we connect the dots, that first trend line looks like this. And then eventually the trend got going steeper and it looks like this. Now notice that the market broke the steeper upward trend line 4 weeks ago, but it didn't do it from a falling top yet. You can see that we hit a new high before it started to roll over. So that is a sell signal, but not a strong sell signal. It is stronger if we build a falling top and then break down from there. Now you might be saying, well, it looks like maybe we need to be out of the market. Well, you can always be in the market. Even when the trend is down, there are ways to make money in the market because Wall Street has created all of these new products that allow us to capitalize on a downward trending market. They are called inverse ETFs. And there's inverse ETFs on the overall market. There's inverse ETFs on individual stocks. And it's a great way to profit from weakness. So here is an example. This is the inverse of the NASDAQ 100. And this is a very short-term chart now. So you can see here it's a 30-day, 60-minute chart. The 30-day, 60-minute chart was moving down, but this is inverse. This goes up when the market goes down. This goes down when the market goes up. So remember I said that we broke the upward trend line about 4 weeks ago. So if we just go back to this chart of the S&P, right there 4 weeks ago, is when we broke the upward trend line on this weekly chart. And if we now go to the very short-term chart, what do we see? Well, you see what we've been talking about so far. We had a downward trend line. We built a rising bottom, and we broke the rising bottom right there on February 23rd, I think. Maybe the 21st. I don't know where the weekend fell there, but right here. And since that time, it has been in an upward trend until last week when we broke that short-term upward trend. That's when the market started to recover. If you've been watching my YouTube videos, you'll know that I was bearish on the market through this period, and I switched back to neutral in the last week because we've started to reverse again. The market has started to move up. If the market's moving up, then that means this is moving down. If the market's moving down, then that means this is moving up because this is an inverse ETF. My point in showing this, though, is that you can make money in any market condition, whether it's up or down. You can use these inverse ETFs to profit when the market's moving down. If the market's moving up, then you just own stocks like you normally would. All right, so I said that we were going to use our knowledge that we've gathered so far to know when to buy a hot stock or when to buy a stock that could become hot. And we're going to take those same concepts that we looked at, and now I'm going to give you the formula, the algorithm, the set of rules that I use for when to buy. And I use this whether I'm day trading, swing trading, position trading, long-term investing, doesn't matter. We just apply it to a different chart. Okay, so to find a hot stock, we want to look for the abnormal price gain with abnormal volume from low volatility where there is a surprise. So what I love to see is a stock that's boring, and then there's a surprise. We have low volatility. Ideally, we're going to have optimism. We're going to have the surprise where the volume is abnormal. And the thing that motivates that to happen is some investors trading on some new information that was not previously widely known. Okay, so let's go back to our charts that we had at the top of the class here. And I want you to look at this and see if you can figure out, there's a couple times on this chart where there was an abnormal price break from low volatility that surprised the market. So right here and right here. Here we have low volatility and a surprise. The volume increased. Here we have low volatility and a surprise. Abnormal volume. Now from here to here, that's more than 100% gain. I picked this stock right there on that day. I missed this one. I picked this one. To this day, I have no idea what this company does, but on that particular day, a friend of mine called me, a guy that I like to mountain bike with, and he said, do you have any stocks that I should consider buying? I said, yeah, buy this LX. I think he then said, what do they do? My answer was, I don't know. I don't really care. What I know is the people that know the most, that follow this company the closest, were buying aggressively because there was some new fundamental reason to pay more for the stock. And I actually don't want to know. I don't want to believe in the company. I don't want to believe in the story. I just trade market activity. But what I trust is that the people who are buying here, they know what they're doing. They're not, a charity. They are buying because there is a good reason to buy. And I just follow what they do. I'm following in their footsteps. I'm always one step behind, but I'm also 20 steps ahead of the general public who's been buying for the last 4 months. So why did I buy there? Low volatility, abnormal volume, abnormal price action, optimism, breaking through resistance. So we had resistance. Resistance was the upper value that no one had been willing to pay more than. No one had really been willing to pay more than $4 a share. And then one day, some investors said, actually, we're going to pay more than $4 because we know that good things are coming. The people that know the most were buying there. And they did so aggressively. Look at the volume. It was probably 3 or 4 times higher than normal. Let's look at another example. So see if you can figure out the times when this would have been a potential buy. Well, here we've got this long line of resistance, low volatility, and then a surprise break with strong volume. We had it here too, low volatility and a surprise break with a little bit more volume, but this was the best one. And then the stock went for a strong move, more than doubling in price. Here's a day trade. So we can apply the same methodology to day trading. Now, when I'm day trading, I usually look at a 2-minute or a 1-minute, sometimes even a 10-second chart. But I'm looking for the same thing. I'm looking for low volatility, abnormal activity that surprises the market. I do not want to be a buyer up here because this is not breaking from low volatility. This is all high volatility. This is low volatility. This is the break from low volatility. Here we have low volatility and a break from low volatility. Right at the end of the day, it moved from $11 just a little after 3 o'clock. By the market close, it was at $14. So that's, a 25% gain roughly in less than an hour. Now, this is sort of the simple way that I approach the market. There's more to it than what I've talked about tonight. We have to think about risk management. We have to have tools to find these things. And these are all things that I'm going to elaborate on through the week. So tomorrow, we're going to focus on investing. So finding stocks like these two. On Thursday, we're going to focus on day trading, finding stocks like this. And then on Saturday, I'm going to show you the tools that I've created to find these things before it's too late. Because finding it an hour later isn't going to help you. You got to be able to find it on time. Here's one more. This is for a swing trade. I've got low volatility and I've got a surprise. And the volume jumped up. That was at I don't know, about $7 a share back on March 13th. A couple days ago, it hit almost $70 a share. I think most people would be very, very happy with 1,000% returns in, I don't know, 8 or 9 days. I still don't know what this company does. And I don't want to, because there was also a very good sell signal right here. And if I knew too much about the company, if I believed in what they were doing, if I fell in love with the story, I might still be holding now that it's gone down quite a bit. But as long as that trend is intact, I'm going to stick with it. And when the trend goes parabolic, where it goes from being a straight line to a curve, then I'm going to get even more aggressive when it starts to break down. I don't expect to get out at the high. That's not realistic. I don't expect to get in at the low. That's not realistic. I try to take most of it in the middle. So buy in here, sell up in here. Now let's talk about how to avoid big losses. As traders, as investors, we have to plan to lose on every trade, because no investor, no trader is right 100% of the time. The key thing is, when you're wrong, to take a small loss, not a big one, because you are going to have winners and they have to pay for your losers. If your losers are really big, then your winners have to be really big and you have to have a lot of them. On the other hand, if you can manage the size of your losses so you don't take big losses, you can be that much more effective in the market. You don't have to be right as often as you might if you had big losses. And you don't have to have huge wins to cover huge losses. So it becomes a numbers game. Okay, in my courses that I teach, I talk about something called expected value of a trading strategy. So the expected value of a trading strategy thinks about how often am I right versus how often am I wrong, and how much do I make when I'm right versus how much do I lose when I'm wrong. You can be very profitable being right only 50% of the time. Because if you're right 50% of the time, but you make 3 times what you lose when you're wrong, after 10 investments, 10 trades, you still do quite well. On the other hand, you could be right 90% of the time, but if you only make, let's say, $1 a share when you're right 90% of the time, but you lose $10 a share when you're wrong 10% of the time, do the math. You actually lose money over 10 trades, because your huge loss outweighs the 9 wins that you had, which were relatively small. So we have to have a methodology for when to lose. And we're going to go back to our concept of inflection points for this. So we're going to determine our risk on a trade based on where the inflection point low is. And when we see a break of support, either with a trend line or horizontal support, we're going to get out. We never want to trade against the trend, and we want to be cautious with parabolic trends. I talked about parabolic trends on the last stock, but let's dive into this example here. This is Tesla. Some of you probably heard of this company. So it had low volatility here, and it broke with abnormal activity there. And then it had a period of low volatility in here with some optimism, and it broke from that there. Now, if I'm buying here, let's draw this a little better. If I'm buying there, I look to my last inflection point for the place where I will limit the size of my losses. So that is my risk. If the stock were to come down through that floor, I'm going to take the small loss right there. Now, as the stock is moving up, I can keep moving up my floor price every time there's a new inflection point. And when the inflection point low gets broken, that's my signal to sell. So I had a buy point here at $300 a share, and I had a sell point here at $410 a share. Look what happened after the stock broke the upward trend line from a falling top through this floor. Down it went. Now you can see in the last 3 days it's gone up, but it actually still hasn't broken the downward trend line. What it's doing right now is snapping back from being oversold. Now, I say oversold because price fell away from the trend line. So you can see here how price fell away from the trend line and then it's now coming back to it. It'll probably get stuck at the trend line. I think it'll get stuck at $290 to $300 a share. But there was actually a very good short-term swing trade in there the last few days. And those who are, in my active live service know that we've talked about Tesla quite a bit lately because it was a pretty good buy at $250 a share. It actually gapped up, so we didn't really get it until I think 257, but today it closed at 280. So, it's up 10, 12% so far, just in the last couple of days. Let's look at another example. This is a day trade from today. And what I want to highlight is, again, the break of the upward trend from a falling top, right there, breaking down through a floor. And then it built a new floor right here, and it broke down through a floor right there. These are strong signals to sell. If you're going to be a successful investor, a successful trader, you have to take those sell signals. One of the great failings of many in the market, and the reason why people have a hard time beating the market, is they don't know when to sell. So I've given you a little bit of a lesson on that. We'll elaborate on this through the week. And then, of course, I go into much more detail in the courses, which I'll talk about in a moment. But on MLGO, look at that. Strong sell signal there at just about $15. Wasn't more than an hour later, and the stock was at $11. This all happened today. I grabbed this chart today at 2:07. You can see when I grabbed the chart. So how can I help you do better in the market? First thing everyone should make sure that they've done is subscribe to the Stockscores YouTube channel. Because I put up at least one free video every week, sometimes more. This past week, I think I did 2 or 3. And then, of course, we've got these free classes this week, which I'll elaborate on in a moment. Tonight is the first one, and I'm glad you're all here because this is the important foundation for the rest of the week. We've got our courses, which I'll talk about in a moment, memberships to stockscores.com, where you can learn my very specific strategies for when to buy, when to sell, doing your risk management, having emotional control, having access to my tools, including something called Active Live and the Stockscores Market Scan. Now, I'm going to be taking your stock questions. I'm going to walk you through the different tools that we have on the website or the education center. But before I do that, I'm just going to launch a poll because I want to know if you want to have some follow-up emails from us on the different offerings that we have. I don't like to bug people I certainly don't like to spam people because it drives me crazy. So if you have an interest in getting an email from us later this week with some information, pricing, that sort of thing for the different memberships we have at Stockscores, just say yes, and also what you're interested in. If you'd rather not, say no, I'm not offended. And that way I'd put you on a list and we'll send you a couple emails later in the week. Now, while I'm doing that, we'll just leave this up for a moment. The next thing we're going to do is walk through the Stockscores Education Center. So the Stockscores Education Center is a tool that I built to help investors and traders learn my approach. Now, I've given you the 45-minute overview, but of course it goes a lot deeper than that. Much more on actual buy signals, how to find opportunities, the tools to find them, and that's all in the Stockscores Education Center, which is the thing that we're going to look at next here. So I'm going to shut down this poll right now, and let's dive back in here. So first of all, what are the lessons coming up through the rest of the week? Well, tomorrow, Wednesday, March 26th, we will talk about investing. So the class is called Creating Wealth, How to Invest in the Stock Market Successfully. I'm going to take the concepts that we've talked about tonight and elaborate on them and show you how I find things. So we're actually going to scan the market with a tool that I built called the Stockscores Market Scan. We'll scan the market and I'll show you how I find position trades. So position trades are trades where we hold the stock for more than 2 weeks and usually a few months. Sometimes a couple of years, but usually it's a few months. We'll talk about how to evaluate risk, how to evaluate the reward potential, exit signals, that sort of thing. So that's Wednesday's session. On Thursday, for those of you that have an interest in trading for full or part-time income, I'll talk about how you can become a day or swing trader using my methodology. And so we'll focus on short-term charts, 1 minute, 2 minute, sometimes even 10-second charts to identify places to buy and sell. Sometimes we're in and out of a trade in 4 minutes, sometimes it's 4 hours, sometimes it's 4 days. That's what we're going to cover on Thursday. And then if you want to learn more about my tools, I'll show you the tools that we've created at Stockscores.com. Some of them very sophisticated that give us an edge in the market. It allows us to find stocks quicker than most people find them, so we can beat the crowd. And I'll also talk about the different membership options at Stockscores.com and some of the bonus training that is included in April. Now I'll go through that really quickly here. So there's the webinars. If you want to register, just go to Stockscores.com and go to the upcoming events, or even on the home page. In fact, I'll just show you quickly here. If you go to the Stockscores website and just scroll down, see here it says upcoming events. So this is what we're doing now. And then of course there's the Wednesday one. You just click on more info and you can register there. While you're at the Stockscores website, make sure you're registered for the free weekly email. I'm already registered, so it won't let me register again, but normally you would see a sign up there where you put in your email address, and every Monday I send out an email with some stock picks, some trading tactics, links to my videos, that sort of thing. All right, so let's talk quickly about the Stockscores Education Center. So I've built this online education tool so that you can go through a number of modules at your own pace. Some people go through it in a weekend. I used to teach this as a class at different universities, and do it on a Saturday and Sunday. So 8 hours a day we would go through this class. That was great because people got to learn from me directly, but the downside is it wasn't recorded, and so the students might go away from that class having forgotten some things. So now it's all online, so you can watch these videos as often as you like, and they look like this. If we go to the Stockscores website, go to the Trader Training section, Education Center right there, and we have the basic stuff. You can go look at these now. These are all free videos. And then we have the foundation, which is the theory, I guess. A lot of the things we've talked about tonight are covered in the foundation. And then we have specific strategies. Specific strategies for when to buy and sell for investors is in the investor section. And specific strategies for when to buy and sell for day and swing trading, as well as using some of the tools in the active trader section. So that's the Education Center. I will go into that in a lot more detail on Saturday. I just want to give you a quick overview. Now we have the investor membership, which gives you access to all of those lessons, my tools, and email support for me, which is perhaps the most valuable thing because I can guide you on your learning process. I only teach about 100 people per year. I don't really want to teach more than that. I'm a trader primarily, but I've built these tools which cost me a lot of money to build, and they cost me a lot of money to keep up. And so it makes sense to have a small number of students and members of Stockscores that sort of keeps everything going. The active trader membership includes everything in the investor membership, plus the active trader strategies, access to my active live. You're eligible for it. It has an extra fee every month, but it's where I am, monitoring the market, analyzing the market in real time, looking for trades every day. There's something to trade. So this active live, it's a live webinar that runs during market hours every day. And it's my computers running algorithms and analysis on the entire US stock market. We don't cover the Canadian market for day trading because it's not liquid enough. We do cover the Canadian market for longer term position trading. And I'll show that tomorrow and Saturday actually. But for day trading and swing trading, this is the tool here, Active Live, but it's only available to active trader members of Stockscores. And again, I could open it up to the world and have 1,000 people in there. That's not what I'm trying to do, because if there's too many people chasing the same stocks, then it doesn't work. And always be suspicious if you see a chat room with hundreds or thousands of people in it. It's really hard for anyone to be able to succeed with that because you're all chasing after the same thing. So this is a small group of traders that have learned my approach, and we monitor the market every day and look for day and swing trades. So I'll just leave this up quickly. Now, at this point, if you have a question about an individual stock, then you can throw those in there. I'm going to cover, I'll take a look at maybe 5 charts. And so we can take a look at that. This is just an email that I got from someone, and it really shows why you would have a motivation to do one of my memberships. Again, I don't teach a lot of people, but I take a lot of pride in stuff like this where people find great success with what I've taught them. And I've got lots and lots of those emails. I'll share some more of those through the week. So the live training is a thing that I do twice a year to complement the online trading. So normally it's the online classes, which are all on the Education Center on Stockscores.com. But I'm also going to be doing some live classes, much like this that we're doing tonight. And that'll be starting Monday, April 7th. We're going to do theory Monday and Tuesday for about an hour and a half. I'm going to hold your hand, walk you through the process. And then we're going to practice doing market scans, which you'll learn more about tomorrow. Market scans Wednesday, Thursday, Friday. When I say tomorrow, I mean Wednesday. I know some of you might be watching this as a video. And so it's Wednesday that we're going to be doing that investor session, and Thursday on day and swing trading. But we're going to do some market scanning the 9th, 10th, and 11th of April. And it's just me applying what you've learned and teaching you how to read charts. It's a process that takes practice, and we're going to practice for 3 days. All of these classes are recorded, so you can watch them later if you're unable to attend some of these sessions. I know we have people in here from around the world, and so I record all these sessions so that people in Europe and Asia can watch these as well. Now, there is a special offer. Anyone who registers for either the investor or the active trader course before Friday, April 4th, so next Friday at 11 p.m. Pacific time, will get all of these classes for free, Monday, Tuesday, Wednesday, Thursday, Friday, 7th till 11th for free. And as an added bonus, I'm going to give you a discount code. So we'll revisit this through the week, but here's your discount code for the investor course, and here's your discount code for the active trader course. At the purchase, when you're in the shopping cart, you put in that code and it will take $500 off of the course. So either the investor course, $29.95, this is Canadian dollars. I know we have a lot of people in the US here. So if this is Canadian dollars, it's significantly cheaper in US dollars. Active traders, $39.95 Canadian. But again, you get $500 off. So this becomes $34.95. This becomes $24.95. Mentorship, we'll talk more about that on Saturday. It's $54.95. The only thing that the discount codes are not for are upgrading. So if you took the investor course 2 years ago and you want to upgrade to the active trader course, these codes aren't going to work, because you should have already paid these lower prices when you bought the course. So you're just upgrading at this point. And again, I'm going to talk a lot more about this through the week. I just wanted to cover off some of the important concepts tonight so that we can be ready for our other classes through the week. And we're going to start to apply this stuff. So what we did on this class is teach you the theory. So now we can apply it tomorrow and Thursday on investing and day and swing trading. And then I'm going to really dive into the tools that I've created that give us an edge in the market. And that's the tools of Stockscores and my active live service. All right. So I promised that we would look at some stock charts, so we can do that now. And I think I've had a few questions come in here. So let's jump back into Stockscores. And someone asked me about KULR. And please give me the symbols, because if you give me the company name, I don't know what to look up. I know a lot of symbols, but not everyone. All right, so let's look at this one first. So this is a stock that I would not want to be in right now. It had low volatility, and it broke from low volatility right there with abnormal activity, right? It's all lined up there. That was at 75 cents. It went straight up. It made what's called a bursting bubble candle right there, and it gave a sell signal right here. So that was the sell point. This was the buy point. Now, who's in control, buyers or sellers? Well, we have falling tops, so the sellers are in control. It is showing a little bit of improvement because we've built a rising bottom. but we need to break through this level there. It's about $1.80. If it gets through $1.80, probably it will go to $2.50 before it gets stuck again. So if you're a short-term trader of the stock, you might see a little bit of action to the upside, but longer-term outlook is still pretty negative because of that negative chart there. All right, this is someone asking about Tesla, so let's dive into that, because one of the things I talked about tonight is how you can have different approaches to a stock based on the time frame. So if you are a longer-term investor, we are still in a downward trend. So a longer-term investor really shouldn't be in the stock. However, if you were a short-term trader, and let's say you watched my video last week or read my weekly email on Monday, because I told you exactly what to do. I said, if it gets through 250, it's going to be a buy for a swing trade. That was right here yesterday morning, 257. Well, now it's, what did it close at today? 288. So this was the buy point because it broke from optimism through resistance from low volatility with abnormal activity. It's the exact thing that we talked about, but that's on the 15-day 60-minute chart, or I could make that a 15-day 13-minute chart. You see it right there. There was the buy point. There's resistance, optimism, low volatility, abnormal activity, 260, let's call it 260, now 288. So roughly a 10% move in 2 days. To get even more bang for your buck, you could take that stock and trade the leveraged ETF. The symbol is TSLL. And we can dive into the same chart, 15-day, 13-minute. Now, same pattern, right? Resistance, optimism, low volatility, breakout. That was at 970. It is almost at $12. So because this is a 1.5 times leveraged ETF, it moves quicker than the stock. The stock is up 10%. This is up about 15%. Okay, so if you're a short-term trader, it's a hold, not a buy. If you're a long-term investor, I would still wait for, what do we wait for? We wait for a reversal signal. So if I go to the 1-year daily chart, we've got a downward trend. We need to break it from a rising bottom. So come up to the trend line, build a rising bottom and break, then maybe it's worth considering. Probably it's going to take some time. Chart's broken. And the reason I say it's broken is it pulled back too far. So it's going to take some time for this to reverse. I think the only trade here is a short-term bounce trade, which we're on day 2 of. All right, another question, WEED. Okay, who's in control, buyers or sellers? Obviously, sellers, right? Tops are falling. Look at the stock score. We're going to talk about the stock scores tomorrow. They're 16. That's very low. So this is a stay clear of. It's ugly. If I looked at a 3-year chart of this, when did it break down through support? Well, it had an upward trend here. It made a little falling top and it broke the upward trend right there. These are all things I taught you tonight. That was at 35. Now it's at 10. That was the sell point. All right, next one we'll look at is Disney, DIS. Okay, short term, it is in the control of the sellers because we have falling tops. So as an investor, I would not want to be in it. Here's the upward trend line. There's the break of the upward trend line from a falling top, 109 down to 102. These are all the things that I will teach you. I mean, I've given you a little bit of insight so far. There's more to it than what we've talked about tonight. So tomorrow we'll cover a bit more. And then if you really want to take a deep dive, for those of you that are into, that sort of thing, then that's what the courses are all about, and the memberships at Stockscores and the support from me. All right, let's see what else we got here. We got lots of questions. I won't be able to do them all, but let's try a Canadian stock here, V.ARTG. All right, it's gold stock. Gold has been the strongest sector. Who's in control? Buyers. See all these rising bottoms? There's your upward trend line. It's a stock to hold. I would not buy it here because the train left the station already. Here was low volatility. Here was an abnormal break. Here was low volatility with optimism. Here was an abnormal break. Look at that volume right there. That was at $7 a share early in 2024. Now we're at $17 a share. You learn how to do this, you can manage your own portfolio, find stocks like this using my tools. You're going to pay for my courses easily. Just this one stock, 1,000 shares, is a $10,000 profit. Okay, let's do one more. What do we got here? Let's try, I've never heard of this one, DALN. Okay, I'm going to make this a 3-year weekly chart. Okay, so it had a good little run here. It came up to this inflection point. See this inflection point right here? That was resistance. See how it touched it and got rejected? So now we've built a falling top and we've broken the upward trend line. So what do you think that means? Not great, right? Now we can dive in a little shorter term. So let's go to a 1 month, 60-minute chart. And you can see there, tops are falling, sellers are in control, doesn't look great. It does have some support here. Wouldn't be surprised if it made a little bounce, but I don't really like that too much. All right, somebody asked me about NVIDIA. Let's do NVIDIA because it's so many people follow it. Okay, so let's go 3-year weekly. When was this a sell? Here's your upward trend line. Here's your falling top. There's your breakdown from a falling top. Okay, I think that this is not terrible. I think most likely NVIDIA is going to get stuck in this range and it's just going to bounce around in here for a while. But it could, if it starts to move down through this level here, if it starts to go below 105 and break through this floor, I'd get worried. Otherwise, I think it's just going to be a grinder. I call these parking lots. I mean, obviously the stock had a great run, but now I think the market just doesn't want to pay more for it. That doesn't mean you can't trade in and out of it because the range here is pretty big, 105 to 150. It's a big range. So if you can find short-term trades on it, looking at the short-term charts, there might be setups. In fact, if we were to break through 122, 123, might be interesting for a little short-term trade for maybe 10 or 15%, but the long-term picture I don't think looks all that great. However, when did this stock make a break from low volatility? Well, it did one here. So there was resistance there, low volatility there, and an abnormal break. Here is resistance, optimism, abnormal break from low volatility. So this stock met all of our criteria a number of times at $40 a share, $55 a share for a nice run. And now it's just kind of going to catch a breather. Okay, so one last comment here. This one came to me last month. I'll just leave that up and I'll thank you all for joining me tonight. And I hope to see you again tomorrow and Thursday and Saturday. They're all going to be full of information and I think you'll enjoy them. So thank you all for joining me and we will see you Wednesday. Bye for now.